My name is Michael Knox, and I'm the immediate past president of the Economics Society of Australia, Queensland Division. This afternoon, we have our Economists Outlook panel. The fact that we are able to put together a panel of such high quality business economists requires the cooperation of the Economic Society of Australia with two sibling organisations. The first is the Australian Business Economists, and even though he's not here, I'd like to thank the chair of the Australian Business Economists, Stephen Halmarik, for being really helpful in suggesting that a couple of these highest quality economists were invited to present to us this afternoon. But I'd also like to thank Julian Pearce, who is one of our vice presidents who is not here, who also has invited a representative of Deloitte Access Economics. So to present to you this afternoon, we have Stephen Walters of JP Morgan. We have Adam Boyton of Deutsche Bank, and those two excellent speakers will be followed by Rick Symes of Deloitte Access Economics. Now, the presentations will take the following form. Each speaker can speak for as long as he likes, as long as it's not longer than 25 minutes. After 22 minutes, I will raise my hand. I'll be sitting in front of the speaker in a 3-minute warning, the same as is used in the case of nuclear attack. After 25 minutes, I'll get up and I'll stand beside the speaker until he stops talking. And then the next speaker will arise. At the end of the time in which our three presenters have provided you with their views, we'll come up, form a panel, and you see that panel, that's where our panel will be, and then we'll have half an hour of discussion of issues. I'll ask a couple of questions, and then we can open up to this very intelligent audience. So the first speaker is Stephen Walters of JP Morgan.
Great, thanks for that, Michael. And I must say it's been a very long time since I've been in a university lecture hall, particularly on a Friday afternoon, very late on a Friday afternoon. In fact, I don't think I've ever been in a university lecture hall late on a Friday afternoon, but anyway, it's a new experience. So look, I'll talk for 10 to 15 minutes, I promise. It's not going to be longer than that because I'm conscious of leaving things to say for my esteemed colleagues here. But you'll notice the subtitle of my presentation is The Dark Side of the Boom, and I'll come to that soon. I'm talking about Australia here. I think we've obviously had a very good 3 or 4 years at the peak of the mining boom. That's clearly gone into reverse in the last 3 or 4 years, and I'll talk through what that means for our national income and for our GDP and for the jobless rate and what our central bank might be doing about it and otherwise. But I'll also just mention some global themes because I think it's important just to have a bit of a context here as to what's going on in the global economy, and of course we can focus on Greece if we really have to, and also China, what's going on in their financial markets. So I wanted to, these are forecasts of GDP growth globally. Now I'm drawing on the forecasts here of all my colleagues in JP Morgan across the world here, so there's 50 odd different economists who form these forecasts about global GDP growth. The left-hand slide is what our forecasts are for the next sort of, 9 to 12 months from here. Now, I have to put a caveat on this and say these forecasts were formed before we assumed Brexit. So we actually had as our base case from our European economics team that Greece would stay within the Eurozone. They'd come up with some sort of deal at the last minute, would hold the whole union together. Our forecasts have now changed, given developments in the last week or so, and of course there's big events coming up this weekend, but we're now assuming that Greece leaves the Euro. We'll probably have to downgrade some of our growth numbers. They are not reflected in these numbers yet. And I was on a conference call last night, as we do every Thursday night, with our global economics team, and we're probably downgrading our Asia growth forecast as well. So that is also not reflected in this number. But a couple of those caveats aside, that looks like a pretty constructive growth outlook to me. The black bars are the ones that matter most. That is what we're forecasting for annualised global GDP growth over the next 12 months. Looks okay. In fact, notice Q1 is the first little black bar there. That was the worst non-recessionary growth in the global economy in something like 2 decades. So we're actually assuming from here that things actually go quite well. The PMIs on the right-hand side, I know non-market economists don't get as obsessed about these things as we do, but they're not looking too good. And I think the clear sign here is that manufacturing is the core weakness here, but also the services part of the world economy is not going that well as either. But I must say there's a couple of things that are going well. One of them, left-hand side, this is what we put into a composite policy rate around the world. Interest rates in the G7 economies are still pretty close to zero, and they're going to stay there for a long time. Yes, the Fed might be raising interest rates sometime soon. We're still forecasting September, which I think is becoming a fairly heroic forecast given what's going on, but I'll stay true to my US economist. He's forecasting a September lift-off for the Fed, so that's what we're assuming. Even global interest rates, including all those emerging market economies with much higher interest rates, they're still pretty low. And if you add the QE effect on that, which we don't have on this, remember the big 4 central banks around the world have been doing quantitative easing. If you add or subtract, more appropriately, off that G7 interest rate, it probably means the effective interest rate is somewhere between -2% and -3%. That's massive monetary stimulus around the world, okay? The other thing that's going on, right-hand side, energy prices are still very low. Yes, there's been a bit of volatility, but this gives a very, very big free kick to consumers around the world. When you've got energy prices this low, okay, the last time they were down here was during the global financial crisis. That was a very different situation. This time it's actually, we think, a really positive stimulus to what's going on in consumer spending power. And ultimately, what it should do, skipping back a couple of pages, is drag up that manufacturing part of the global economy. Because the big surprise, I think, in the last 12 months, certainly for our economists, has been how weak the manufacturing part of the global economy has been. But the virtuous cycle here is you get interest rates very low, policy works, consumers start spending money again, the labour market improves, and we're seeing very, very good improvements in the US jobs market in particular. Incomes go up, you've got the nice free kick from energy prices being quite low. The service part of those PMIs start lifting, and ultimately the manufacturing part of GDP goes up as well. So we call it a virtuous cycle, and what you should end up with, now there's a lot of numbers there, but concentrate on perhaps the 2016 forecasts for those various economies. Most of them look okay, and in fact I'll highlight just a couple of them. Look at my colleague's forecast for European GDP growth next year, 2.5%. That's a chunky forecast. Now, again, I'll make the caveat that if Greece does exit the euro, which is now our base case, that number probably goes back down to about 1.75 to 2%, because we think the sentiment channel here is already being impacted. We don't think it's a financial contagion, European Central Bank loses control here. We think it's more about the sentiment channel that's already been hit, affects consumption around the rest of Europe, that affects the manufacturing cycle and so on. So we might have to downgrade that a bit, but I'll also point out another forecast there. Look at Japan, 1.5% growth in Japan. That's a pretty punchy forecast too. And again, I'll come back to the point that we think policy works. That if you throw the kitchen sink at your economy, both with fiscal, monetary, QE, reform, it works. It'll take a while, and Japan faces some horrible demographic ticking time bombs, which perhaps Rick might talk about in his longer term discussion at the end, but cyclically we really like those two economies. Plus we like what's going on in the US. What have we got there? 2% and a bit growth, that's okay. We think potential growth in the US is only somewhere around 1 to 1.25%, so they'll be growing well above potential over the next 2 years. And you can read through all those other economies as you like. I'll point out China. We've still got 7% growth for China. Yes, there's some financial stability issues at the moment. We don't think that's a really big systemic challenge to that economy. We think they've got enough financial firepower to actually do what they're doing in the market, which is actually stabilising things. The big risk is a sentiment channel. Again, that's already probably been hit. It could trigger more cautious behaviour from consumers and businesses and some probably irrational behaviour by some, but notice our forecasts haven't changed that much. I asked our China economist last night, what would you do to this growth forecast if this ended up in a very disorderly share market reaction, in addition to what we've already seen? And he said I'd probably only take off about 0.5% off that growth forecast, take it down to 6.5. So just keep it in perspective. There's a lot that's going right in China. Yes, there's this big shift towards consumer-led growth, away from this sort of industrial, urban infrastructure-led growth, and they've got a lot of financial firepower out there. So we think, don't panic. Greece, I won't dwell too much on Greece. Just notice what's going on in their bond market. Would you buy Greek bonds now? They've just defaulted on the IMF. It's almost certain they'd default on you if you did it, so I wouldn't touch those, but we can come back to that. And I won't talk about markets in the interest of time. Now here's Australia. So look, they're my growth forecasts. I can't blame these on anyone else. They're mine. So the black bars are what I'm expecting for Australian GDP growth over the next sort of, 2 years. That looks pretty constructive as well. Remember what I called this presentation was the dark side of the boom? That doesn't look that dark. That actually looks pretty good, right? I've got GDP growth going, as John Fraser has told us in his lunchtime speech, from about 3.8% annualised in the first quarter to somewhere about 4% in 2 years' time. What's the problem? That's great GDP growth. Most of those economies, just skipping back a little bit, there aren't too many in there that are getting somewhere around, what have I got for Australia? 2.8 this year, 3.2 next year. Most of those economies are way below that. So what's the problem? Why am I talking dark sides of the booms? It's mainly the income side of the story. Okay, and John Fraser alluded to this in his speech at lunch as well. This is great GDP growth, but there's two main problems with it. One is 2/3 of it's coming from net exports. So in other words, just shipping more dirt out through the ports, more volume out through the coal mines and the iron ore mines in Western Australia and so on. That's fantastic, that's great growth, but it doesn't really help me. I don't work for a mining company. Whereas back in the terms of trade boom, and I'll show you a chart on that soon, we all benefited from the income lift that gave to the economy. But when it's an actual volume story, the benefits are much, much smaller, and most of them leak overseas. About 2/3 of those benefits through either share price gains or company profits or dividends go overseas, because the companies often are listed offshore. So that's one problem. And the other is, it masks a very, very poor income performance in the economy. So that's a volume story. This is real per capita disposable income. I think it's now 9 quarters in a row that has gone backwards. Now that normally only happens in a recession. I remember these recessions. I was working in Treasury back in those dark days, sadly. Normally you get very, very big compressions of national income during recessions or during the global financial crisis, but it's normally very sudden and then it comes back. This is a very, very, not particularly painful, but quite elongated compression of national income. And that's quite painful. That's why the budget position is dire. It's why wages growth is the weakest in 20 years. It's why parts of the nominal economy, company profits aren't growing very strongly. And all of us live in the nominal world, okay? We don't live in this part of the economy. That's volume. We live in the real nominal part of GDP, and it's really getting squeezed here. That's one problem. The other is, and again I'll allude to what John Fraser said in his speech because I was going to talk a fair bit about it, but notice this is the terms of trade. I mentioned when that terms of trade went up, for the non-experts here, that's export prices divided by import prices. So this is what happened during the global financial crisis when China threw the kitchen sink at their economy. Coal prices tripled, iron ore prices doubled, the exchange rate went up, import prices went down. It doesn't get any better than that. It's our global purchasing power, or our living standards, if you like, and they peaked at 120-year highs. And Glenn Stevens keeps talking about this. It doesn't get any better than this. The problem is it gets a lot worse. And this is what's been happening over the last 3 or 4 years now, as iron ore prices, if you'd noticed the last week, they've been off quite a bit, 25% off in about 3 weeks, I think the number is. So we're down in the 40s again. So this line probably has further to come down. You might think, so what? I don't work for a mining company. Why do I care what coal prices are? It's because it drives national income. And that's the red line on that chart. Notice when it really took off and diverged from the blue line. What's the blue line? Productivity. When those two lines diverged was when that terms of trade took off. The problem is, now that red line's coming down, those two lines are going to converge. So that means the only thing that will really drive our national income is not commodity price booms, but productivity. And again, John Fraser mentioned it in his speech. The big problem is, look at Australia's productivity performance over the last decade. Multi-factor productivity is the one that matters. It's been basically either down or negative for a decade. That is just terrible. That is awful. And I think it's Ross Garnaut calls this the great complacency, that we didn't have to worry about things like productivity or working smarter or using technology better because our national income was booming. Didn't matter. We could be a bit lazy, a bit complacent, not use technology in the right ways because income kept going up. Well, guess what? Income's not going up anymore. In fact, it's going down. So we really need to turn that around. And much better than we've done on output per hour work. That's only one form of productivity. And that's simply because the mines are now starting to churn out all this new output for all the new inputs that we've put in terms of expanding mining capacity. This is a core problem with the economy. If you're thinking about one thing that's really missing in this economy, sort of consumers have come back a little bit, that's okay. The big thing that worries me is when I talk to corporates, and we do a lot of interactions with the corporate sector, mining companies and other banks and retailers and so on, they're telling me their appetite for investment and hiring is pretty low. And that's what's going on here. That's non-mining investment as a share of GDP. It's, what's that, about a 20-year low. Lowest since the recession that we had to have, the famous recession we had to have back here. It hasn't been lower than that for a long time. Now, corporates tell me they're not worried about the cash rate. They like that the Reserve Bank's been cutting interest rates, that's very helpful. What they're really worried about is that previous chart, is no productivity growth and in government, very little appetite to do anything about it. So again, referring to John Fraser in his speech, which I thought was a great speech, he went through the things we need to do. Get productivity to go up, be more efficient. He even mentioned industrial relations reform, which Tony Abbott won't go near. They've kicked tax reform off into the long grass in the form of reviews. Everything that needs to be done is not being done. Okay, so this is really a problem for our economy, and it's what corporates tell me they're really worried about. They don't care about the cost of capital, it's low. What they really need is all this other stuff to change. Intergovernmental relations, productivity, labour reform, tax reform, tariffs have been done, but just lots of stuff that can be done in this economy and not much is being done about it. That's what they're really concerned about. I'll make just one more comment and then I'll leave it to my colleagues. This is a chart of the remaining, and this is on the Aussie dollar, this is on the remaining sovereign AAA rated countries around the world. And now by AAA rated, I mean those that are AAA rated by all three major rating agencies, Fitch, S&P and Moody's. Notice there's only 7 left, and unfortunately we're one of them. So I call it the curse of the AAA rating. Yes, we have low borrowing costs, but we're the highest of that bunch. So every time the Aussie dips, and we've seen it this week, we get a lot of other central banks around the world, sovereign wealth funds, come rushing in and buying Australian government bonds because they're the highest yield and we're perceived as being a pretty safe economy when the rest of the world is particularly a bit risky with Greece and China and so on. So my concern is one of the really things that would really help this economy a lot would be a lower currency, and we sort of have, well, we're at a 6-year low this week, but this to me really stops it going lower. I think without this curse of the AAA rating, the Aussie dollar could be way back down where it was, like during the global financial crisis, it got to 60 US cents, and during the Asian crisis and the US recession back in the noughties, it got down to 48 US cents. So here we are sort of stuck at 75, and I think it's because of this chart, effectively. So we've still got policy levers. The Reserve Bank has 200 basis points to play with. I don't think they'll have to use it, because I think the currency will slowly drift off. I don't think it'll plunge, I think it'll slowly drift off. And there is budget room to move. Like Joe Hockey could let the automatic stabilisers kick in. He's saying he won't, but I think he should. And actually not have any sort of fiscal drag from the budget, just to cushion what is a really big transformation that's taking place in this economy. And just to keep that in context, we've had this massive boom. We had the terms of trade at 120-year highs. We had investment as a share of GDP in mining at 7% of GDP. Now we're getting the export phase of that boom. Fantastic, that's all good. When that sort of thing happens in your economy, you've got a big adjustment to make. And we're sort of only halfway through that. And it's quite painful, and our income is adjusting down. I think the quality of policy is quite poor, and we've got political instability at both federal and state levels, which is not helping corporate confidence. So we're in the midst of a big transition. I think if you look forward, and again, I don't want to tread on Rick's territory, but if you go forward 15 to 20 years, I think we'll be in great shape because we'll be exporting into Asia. We won't be exporting as many commodities, but we'll be exporting things like services and education and healthcare and tourism and food. And I think we're in great shape for that. But right now, looking where we are at the moment, we're in the midst of a very large transition, and it's a work in progress. I'll stop there.
Isn't it amazing what you can say in just under 20 minutes? I'd now like to invite Adam Boyton from Deutsche Bank.
Just give me one moment while I attempt to find the slides. There we are. This presentation, I'm actually filling in for a colleague today, and when I saw the very bright, colourful page that he'd started with, it looked not like green shoots to me, but rather like the entire forest had been regrown. I don't wish to leave you with that impression for too long, because I don't disagree terribly much with what Steve said when he went before me. What I might do is skip through a number of the slides fairly quickly indeed, not touch on them, but just focus on a couple of things that might be of interest in the current environment. And the first, and being a European bank, I guess at Deutsche we're a little interested, to say the least, at what might be happening in Greece. Essentially, our core view is still that in the 11th hour, as these things have progressed over the past couple of years, a deal will again be done, although as the past 2 weeks have moved on, your confidence in that would have to be getting less and less. I think we're describing it as a finely balanced call, as often these things are in this business. I think there are a couple of points to make about Greece, and the first is that chart on the left-hand side there, which is that the banking sector's risk, or the banking sector's exposure to Greece, is now a lot less than it was a number of years ago. The second point to make on Greece is that the Europeans now have firepower or frameworks in place that are preventing the sort of contagion we used to see 2 or 3 years ago. If we'd had this Greek crisis 2 or 3 years ago, not only would have Greek bond yields risen, you would have had a massive surge in Italian, Portuguese, Spanish bond yields. That actually hasn't happened this time around. So that lack of contagion, plus also the reduced exposure of the banking sector, does make us think that although a Grexit would be problematic and incredibly traumatic for the Greek economy and the Greek people, and that if there is a Grexit and the Europeans do start moving toward that on Sunday, if that's what they do, the first thing Greece will need is humanitarian aid. That's not to, so my displaying or downplaying of the contagion risks is certainly not to downplay the risks for the Greek economy. Globally, we still think, as does JP Morgan, that the Fed will lift off in September. I should say that, as like JP Morgan, our US colleagues are starting to be a little less strident perhaps in the language. The call's becoming a little closer there. We still do see, though, the US economy is recovering. It's a question of, does the Fed see yet labour market slack having been reduced sufficiently come September, or are you pushing that back through to December? But we certainly do see the Fed lifting off this year. In China, we have growth sitting around 7% for the next few years. We see the, I guess, volatility or the weakness in the equity market in China over the past few days, past few weeks, as something policymakers will respond to, and that additional easing in China will help put not so much a floor under growth, but help see growth in China pick up around the second half of the year. The chart down the bottom there might be of interest to some. It just plots Chinese equities against the Nasdaq going back about 2 or 3 years from now. You shouldn't take the path of the Nasdaq as being Deutsche Bank's forecast for the Chinese equity market, I should say. But what it does do is underscore, I guess, the enormous effervescence, for want of a better phrase, that's underpinned or, has been associated with the Chinese equity market, particularly over the course of this year. If I jump to Australia, I think a number of things have changed in Australia over the past 6 months that make us a little bit more confident on the outlook for the Australian economy than we were at the end of last year. At the end of last year, on the day that the Reserve Bank said that interest rates would be staying at 2.5%, we decided that no, they'd be cutting 50 basis points this year. I then proceeded to get the first 3 RBA meetings of the year wrong. which is sort of problematic in this business. Even when your long-term forecast might be okay, it's the short-term forecast that the traders remember on the day. But not only has the RBA cut 50 basis points this year, the currency has also fallen fairly significantly from about 95 US cents 12 months ago to around 75 cents today. That is a very significant move in the currency. And indeed, if this move in the currency had probably occurred in the 1980s, it would be something that might have been terrifying policymakers. To have a 20-cent decline in the currency is really quite significant. What it does is, I think, provides a degree of monetary stimulus on top of the 50 basis points of rate cuts. And then there's one more thing that's happened this year that I think has probably not been remarked upon enough, and that is Australian governments have stopped chasing commodity prices lower. And what I mean by that is, if I think back over the past 3 or 4 years, you'd have commodity prices fall, government revenues would be lower on account of that. Governments, either because they'd committed to achieving a budget surplus by a certain date, had committed to having a surplus in the forward estimates, were concerned about a credit rating, often then cut expenditure in response to that. So you had a very pro-cyclical stance of fiscal policy as commodity prices were falling from about 2012 on. Over the last round of federal and state budgets, so the May budget federally, we didn't actually see any discretionary policy tightening on top of what was already in the budget from the previous year. At the state government level, I think you're starting to see on balance discretionary easing. The Victorian government has a 7.1% increase in the public sector wages bill factored in for their budget for 2015-16. The Queensland state government, although they haven't released their budget, I think it would be almost impossible for them to be more austere given the platform they were elected on than their predecessors. And the reason why I think this is so important is really this chart on the right-hand side. What that chart on the right-hand side has is the yearly change in mining sector employment in the blue against the yearly change in employment across healthcare and social assistance, education and training, and public administration and defence. This chart, to my mind, underscores that fiscal policy was not just pro-cyclical during the boom and the first part of the bust at the federal level, but was also fairly pro-cyclical at the state level. In Queensland in particular, I think over the 3 years to 2007-8, you had a 35% increase in the public sector wages bill. You had similar increases in a number of other states. Now, this chart is unfortunately only updated for the first quarter of this year. If I had put in the second quarter data, or I should say more correctly, the data for the 3 months to May, what you'd actually find is an enormous surge in employment across healthcare and social assistance, education and training, public administration and defence. So if you've been looking at the labour force data over the past 6 months, and I have to say to the statistician, I don't mind the odd bit of volatility in the labour force data. It's one of the things that helps keep financial market economists in a job. But if I look at the labour force data and what the Bureau has been producing, particularly in employment by industry, I get this story on the left-hand side, which is mining sector employment. And again, I should note that that's on the right-hand side axis, and so that's down 50,000. Over the past year in construction, retail, accommodation and food services, and they're the industries you'd expect to be doing well in an environment of lower interest rates, an environment of weaker currency. And then professional services and other services and arts and rec, the three bits of the economy that just quietly go and create jobs all year, every year. You don't often see a politician put a yellow vest and a hard hat on and stride purposely through a call centre. But these are parts of the economy that generally quietly create jobs without much government assistance. What I think is quite extraordinary about that chart on the left-hand side too is how the Reserve Bank has done a pretty good job of both depressing those parts of the economy when the mining sector was incredibly strong, and with the benefit of hindsight, having looked at that chart on the left-hand side, the rate reductions we have had over the past few years have been quite successful at stimulating growth. Where we think the labour market's been weak has been in those public sector related areas. And as I say, if Australian governments are no longer chasing commodity prices lower by offsetting weaker revenues with expenditure cuts, then I think we can actually hope that the unemployment rate's gone close to peaking. One of the things we do, not that we think there's anything wrong with the ABS data, but one of the things we do on occasion to cross-check it is compare what the ABS is publishing for employment growth, and this is the chart on the right-hand side, with other indicators that might tell you something about what's happening in the labour market. So that chart on the right-hand side takes the trend estimate for employment growth from the ABS's monthly labour force survey and compares it to a simple unweighted average, so it's just a simple average of 3 different employment indexes from 3 different business surveys, 3 different measures of job advertising, consumers' unemployment expectations and consumer sentiment. And if you just blend these things into one indicator, you find that it does a reasonable job of perhaps telling you what underlying conditions in the labour market are like. And if I look at that chart, what it tells me is that what I'm getting across unemployment expectations, consumer sentiment, measures of job advertising and measures of business surveys is pretty much well bang on line with what the Bureau have been printing recently. And indeed that trend estimate for employment in June, increase of 15.2 thousand, close enough that I don't need to rescale the axis on this chart for a little while yet. What all this means if you're a bit more short-term, and I'll focus a bit more short-term given Rick's going to do the long-term, is that this is an environment that suggests to us that the Reserve Bank's probably not doing anything at all this year and probably isn't doing anything next year given our forecast for 2016 are fairly similar to our forecast for 2015. The chart on the bottom left-hand side is the chart that I use to explain to clients why I'm so obsessed about the labour market and working out where the unemployment rate goes. This chart is the 6-month change in the unemployment rate against the 6-month change in the cash rate. Now, you might say, but hold on, the Reserve Bank's a forward-looking inflation targeting central bank, so why does this chart work? And I think this chart works because if you're a forward-looking inflation targeting central bank, one of the key metrics that gives you a sense of what inflation might do over the coming year or two is actually how much slack is there in the labour market, and is that slack increasing or decreasing? What was actually quite remarkable in many ways about last year was how the Reserve Bank were very firmly on hold all through last year in the face of a rising unemployment rate. If we look at what the unemployment rate's done over the past 6 months, there was a labour force release out yesterday that this chart doesn't have in there. Essentially, the unemployment rate has been unchanged over the past 6 months. That would be consistent with the bank actually having done nothing. What, of course, we have had is the RBA ease, and I think that's probably appropriate given the weakness in the economy we saw, particularly through the middle of last year, that to my mind merited some response. There is, and to pick up where Stephen left off, one area of the economy that would be consistent with fairly significant further easing from the Reserve Bank, and that's on the consumer side. And these are just fairly simple top-down things that we use to get an assessment of what we think the RBA should be doing, independently perhaps of what the RBA is actually saying. So that chart on the left-hand side just blends consumer sentiment, consumers' inflation expectations and consumers' unemployment expectations together in one series, which is in the blue. And against that we've just plotted changes in the cash rate, and you can see that that is still in pretty deep negative territory. And I think what that reflects is really a few things. The first is that if we look at employment growth and the sort of employment growth we're getting and the industries in which we're getting it, it's typically in low-wage industries. So although we've created a lot of jobs in Australia over the past 12 months, and those jobs we've created, even just across construction, retail and accommodation and food services, have more than offset the loss in mining, these aren't jobs that are paying quite what the mining sector jobs are paid. So that chart on the bottom right-hand side all this chart does is adjusts employment growth for the different wage levels between sectors. Essentially what that chart says is rather than employment having grown by about 1.75% over the past year, if you take into account where jobs are being lost and where jobs are being created, essentially from an income side, you're getting employment growth of close to zero. The chart above that just plots back over the past 30 years, consumer sentiment in the red against real per capita household income growth less interest, taxes, and I put operation of vehicles in there just to pick up the petrol price falls last quarter and the increases this quarter. Essentially, although the economy is creating jobs and the unemployment rate looks like it's peaked, and we have the economy returning to trend growth in 2016, which is, I don't think, hugely dissimilar from Stephen's GDP forecast, When you look on the income side of the story, particularly the story or the environment the average Australian's seeing, you're seeing wages growth barely keep up with inflation. At the same time, you're suffering fiscal drag as your nominal incomes are rising, potentially pushing you into a higher tax bracket. And those sorts of things are actually having a fairly significant impact on household incomes. Indeed, if you look at data in the national accounts, for the household sector, around half of the benefit of interest rate reductions from the peak in the cash rate of 4.25% have been offset by fiscal drag. And so I think this is to use Stephen's phrase, the dark side of the boom, that even if we're creating jobs, even if we're stabilising the unemployment rate, getting GDP growth back to trend, for the average Australian that isn't seeing a wage increase, that is maybe transitioning out of a high wage job into a lower wage sector or going back to doing what they used to, or suffering fiscal drag it is a fairly difficult environment. I might just touch on a couple of financial market aspects, and this chart on the right-hand side is one that theoretically probably shouldn't work all that well. For those that aren't familiar with Bloomberg codes, the blue line in this chart, left-hand side I should say, the blue line in this chart on the left-hand side is just the difference between the 4th Australian bank bill future and the 4th US Eurodollar contract. So in English, essentially the difference between what the market thinks the RBA is going to do versus what the market thinks the Fed's going to do. And in the orange line, we have the spread between Australian US 10-year bonds. So this is a chart that says for most of the period shown there, that spread between Australian and US 10-year bonds has entirely been a function of where the market thinks the Fed and the RBA are going over the next year or so. And contrary to theory, doesn't actually reflect shifts in relative sovereign risk or inflation premia. Now, I know that's probably a very dangerous thing to say in front of a conference of economists. I will say that if I took this chart back to the 1980s, it would not work at all. And so this really reflects, to our mind, the maturity of the Australian economy post-RBA independence, return to better quality fiscal situation from the mid-1990s on. Now, that's all very well and good. The interesting bit is, okay, where do you think the 10-year bond spread's going and where do we think the RBA is going versus the Fed? If I look at our house forecast, we'd have the gap between Australian rates and US rates narrowing as the Fed tightens and we do nothing. If we look at the gap between US and Chinese GDP growth, which has been an okay predictor of 10-year bond spreads, that also suggests that that spread between Australia and US bond yields should actually narrow over the coming year or so. If we think about what the coming year or so might hold for currencies, and I know attempting to forecast currencies is probably something else I shouldn't do, but I sit about 6 metres away from our spot foreign exchange traders and I'm afraid I can't get it, or they kind of make me do it. The chart on the right-hand side is one that shouldn't work as well as it appears to do. And that's just the difference between US and Australian unemployment rates against the currency, and what we find is that the Aussie-US exchange rate does a reasonable job of following actually what the relative unemployment rates were doing 15 months ago. Now that might again sound like something that's open to question. I think the only reason why this works is that both central banks are fairly focused on labour market conditions, and essentially what we're picking up there is the same thing we'd be picking up in the chart on the right-hand side here, which is the Aussie dollar against the US dollar in the light blue against this spread between Australian and US 10-year bond yields. So if I have a view that says the Fed's tightening this year and through the course of next, the RBA is doing nothing, both compression in 10-year bond spreads between Australia and the US, but also what we've seen happen already in relative economic performance reflected in the two unemployment rates. That tells me that the currency is falling further. Our number is 65 cents for the end of 2016. We first put that forecast out when the Aussie dollar was trading about 95 cents, so 2/3 there, 1/3 to go. It's looking not quite as silly as it did 12 months ago, I have to say. But this holds, I think, enormous implications for Australians, and we did a slightly headline-grabbing note earlier this week, just taking our forecast for Australian nominal GDP growth, which, like Stephen's, are fairly soft, notwithstanding the pickup in real growth. overlaying on top of that the decline in the currency, and just making the point that in GDP per capita terms in US dollars, we will go from 5th last year, beaten only by Luxembourg, Switzerland, Qatar and Norway, to 9th this year, to 11th in 2016 and 17th in 2017, which is almost giving up all of the gains in per capita income in US dollar terms that we enjoyed through the course of the mining boom. So although I think we have a view at DB that says the Australian economy is probably through the worst, the unemployment rate stabilised, the RBA won't need to ease further, that's also a view that says ultimately this economy goes through in many ways on the financial market side something very similar to what it did during the Asian crisis, which is a unique shock. Well, a shock that largely impacted us, didn't impact other developed economies all that much. 10-year bond spread between Australia and the US came into zero as the Fed took interest rates above actually the RBA cash rate at the time, I think. Aussie dollar fell into the 60s, and that was ultimately generating the sort of very easy monetary conditions that enable the economy to transition reasonably well through this mining, non-mining adjustment. The problem with that is it's a transition that makes you less wealthy. On global stage, it makes your global purchasing power a lot lower than it would have been if we'd managed, I think, a better transition that focused much more on productivity and microeconomic reform. I will leave it at that, conscious that I'm probably getting very close to my allocated 22.5 minutes before somebody stands up and taps me on the shoulder. Thank you.
When you do a lot of presentations, you kind of develop an internal time clock, and Adam was exactly right about that 22.5 minutes, by the way. I point out that what you've seen, for a lot of some of you people who were at the PhD sessions earlier in the week, what you've seen is two absolutely cracking presentations by two really first-class market economists. So that's what you get to do if you want a career in economics and get into financial markets. But next, we have a presentation from Rick Symes of Deloitte Access Economics, and Rick is going to talk a little bit more about the long-term issues of the Australian economy and problems in structure. Rick.
Where are we? Back again. Good afternoon. As has been alluded to a couple of times, I'm going to talk about some longer term issues. When Julian asked me to give this talk, I said, well, I don't really know what the cash rate is. I don't know what the Treasury is saying about the near-term outlook or whatever. I played those games a few too many times in the past, and I'm worried about other things, and hence worrying about longer-term issues. Also, when he asked me, I started thinking about, well, what are some of those longer-term issues? And at that time, the structure of the economy, how that was going to be influenced by what was going on in Asia or emerging markets, how it was going to be influenced by ageing or the digital economy and the like. I'm not going to talk about those really because of recent events, but I just wanted to point out what some of my thoughts about a policy agenda coming out of that, given what John said at lunchtime today. It seems to me that there are a few issues that we haven't really understood or already grabbed hold of on the policy agenda domestically, and they weren't really their centre stage. One is something that John Freeman said, and that's infrastructure. I think that needs to be we need to work out what to do with that properly. The second is how we organise and design our cities, so both the hardware and the software of the cities, get those right, they're big microeconomic reforms. The biggest one is probably the next one, and that's the digital economy. Ian Harper's review talks about competition. What digital is doing to injecting competition into the economy is larger than anything explicitly in any of the policy recommendations in Ian's report, i.e. it is having transformational effects on the economy, injecting a burst of competition that does rival the reforms of the 1980s, it seems to me, but it's market-driven. What we haven't done as yet is really worked out how to take that force and inject it into a few of the areas of the economy which could really do with some big reforms. I'm thinking of health, education, community services, etc. Lots of potential there, and they're three issues that I think need to be central to any policy agenda. I'll put those on the table and more than happy to talk about those at more length later on. But after I started thinking about what I might talk about, then we had a bit of news in China and a bit of news in Greece, and thought, well, it's going to be a bit odd if I turn up to the conference and don't talk about those things at all. But in talking about them, I thought, well, let's look at some of the longer term trends there. Let's look at what it might mean for the longer term health of the economy going forward. So let me go back to begin with and just ask the question, what went wrong? If I go back a decade, look at what was happening to global growth, what we're seeing is global growth was pretty strong everywhere in the world. We'd been through a couple of decades where we'd had success we'd had Japan doing well, or Korea doing well, or different parts of the world going well, but not across the board. A decade ago, Sub-Saharan Africa was doing well, Middle East was doing well, the Eastern European countries were doing well. Strong growth everywhere, and at least on the surface, it was not clear that that couldn't continue. It was not clear that there weren't that there were strong sort of forces at play that might knock it about. Under the surface, unfortunately, there were a few things that weren't so good. So how we were pricing risk in financial markets, or what was going on with financial engineering, what was going on with sort of the interdependencies between financial institutions across the globe. We had the GFC. What I wanted to talk about today is two other things that were under the surface at that stage. One relating to two other imbalances, if you like. One relating to the nature of growth, or the composition of growth, and the development of different parts of the Chinese economy, because I think that we need to understand that if we're going to look forward. And the other one is the Euro experiment. So let me get to those. So first of all, China. China, I totally agree with John. It's hard not to be, John Fraser, it's hard not to be, on average, optimistic about where the Chinese economy is going to go for the next decade or so. It and other emerging markets are going to continue to assume a larger part of the global economy. But let's talk about that in a bit more detail. So what has been behind China's success? To me, it was essentially driven by the unleashing of a lot of latent entrepreneurship from the grassroots up. It wasn't, yes, they've got a centralised political system and all the rest of it, but the economic growth was largely being driven by unleashing entrepreneurship across the board. When they got into a problem, as they did after the Asian financial crisis, or there was the potential of a problem, what did they do at the Asian financial crisis? They said, well, whoops, we better do something else, so we'll put a bit of infrastructure spending in, and we'll make sure that we manage that. We won't go as fast on liberalising the financial sector. We won't go on as fast on some things that we're a bit more uncertain about. What we'll do is we'll just calm it. And they did it really very successfully. To me, a country like China with underdeveloped governance structures, this is from an economic point of view, underdeveloped governance structures or legal systems or financial markets and all the rest of it, unleashing those forces, what it was a recipe for on average, very strong growth, but a roller coaster. What we have seen is very strong growth and a really fantastic ability to keep that rolling along to date. Are there worrying signs? Well, to some extent, the unbalanced growth, the reliance on manufacturing, the reliance on construction and all the rest of it, that is starting to be rebalanced a little bit. We also have the progressive emergence of things like environmental challenges, and those environmental challenges means that you have to be a little bit more circumspect about how much you might come in with a bit of infrastructure or construction or whatever to offset what has happened in the past, i.e. they're really very real concerns and constraining concerns. So they're there. But the big issue in my mind is still to do with the immaturity of the financial sector, and that, it seems to me, is what we're sort of seeing in what is, as John said, a fairly thin and I don't think all that large Shanghai or equity market in China, but those swings in sentiment and all the rest of it, and also they seem to be reflected, as far as I understand, in property markets and other parts of the economy, so there are those concerns. Those swings are a sign that we might be on one of those roller coasters. The other thing is, but what happens? First of all, you need to emphasise that there's still a lot of potential, there's still a lot of upside. This is just GDP per capita relative to the US, and China's not down the bottom anymore, but it's still only about around 25%. It's got a long way to go. You could have other metrics there that we're looking at how much more, copper is needed if we're going to have slightly bigger bedrooms in our houses and all the rest of it through China. You do the numbers, and there's an enormous potential on lots of different metrics. So there's a lot of upside to go, and so we're not going to hit sort of some of the technology barriers for some time. That idea, I think, has got a lot of people thinking about, let's have a bit of a debate about what is the potential for Chinese growth going forward. It's not going to be the 8 and 9% and 10% that you've seen in the past, but it's going to come down, and this is taken from a study that was done in 2014, which was suggesting, maybe coming down over the next 5 or so years to a bit under 7%. From Australia's point of view, or the world's point of view, that's pretty healthy growth still. Just do the calculations. If you have growth of 8% on average for a decade, or I think it's 9 years, you've basically doubled it. And so after that decade, you only need to have growth going half as fast as it was the previous decade to have the same increase in demand for whatever you're buying. And so it still has, that's why that earlier chart you saw China sort of assuming more and more of the world's economy. There is a question as to, when do they get back and buy more iron ore and push up the iron ore price and all the rest of it, and so there's a timing issue there, but they will. Coal's a little bit more problematic because of the environmental issues and the shift to gas and all the rest of it, but gas is good. So there's still really very strong stories for Australia going forward, but you have got that roller coaster issue. I should just mention before leaving China that it's not just only China, it's also India's doing pretty well and Indonesia's doing pretty well, and you can add quite a few other countries in the region. So that story is still there, but with the importance of being able to manage the fluctuations being heightened. What about Europe? Well, Europe was a little bit of is a economic experiment that I think was doomed to fail, and it is failing. I think someone who I don't always agree with, Milton Friedman, sort of said the same, I think, in the newspaper recently. What you had in the early 90s was the wall. The Berlin Wall came down. You had Western Europe and America wanting to welcome these countries back into the capitalist fold. We had things like the EBRD being set up to do that. And you had a discussion between France and Germany about how do we have a more united Europe going forward. So that political dynamic was strong. And it was important to have a more united Europe. So I don't want to say that motivation was the wrong motivation. But then when it translated into what do they do with the economics, let's have a single currency. They obviously knew about Bretton Woods, they obviously knew about the gold standard, and they weren't all that, they ended up not in wonderful outcomes. But the idea was, let's have a single currency, and what we'll do, we know that it was a sclerotic economy through Europe. That was the terms at the time. We're going to use the single currency to remove barriers, get more trade, get more flexibility, and it's all going to work pretty well. Because after all, just look across the Atlantic, that's exactly what the US looked like. A single currency, flexibility, and it all worked pretty well. Why can't we do it? Well, they couldn't do it. And they couldn't do it. The easiest way to describe it is before this happened, you could look at Italy for the previous 20 years, and you could look at the unemployment rates, the level of income or whatever in the south versus the north. So it's a single currency, and you didn't have the flexibility within one country to make the adjustments to the resources moving and whatever to do it. Now we're hoping that the spare resources in Greece or Portugal or whatever will adjust with what's going on in the Netherlands, despite cultural difference, all the myriad of differences there, and it was always going to be a problem. We're seeing, so this is a chart of current account positions between 2005, when the economies were still growing at a reasonable pace, but how it was manifesting itself, so the imbalances there were the current account positions across the countries were wildly different. And if I just give you another chart which is a bit more updated, and if you looked at it closely there, you'd see, well, in fact, the current account deficit sort of narrowed. But they narrowed by crunching economies in those, in a number of countries. And you see that with unemployment rates at the moment, where unemployment rates well over 20% in Greece and Spain, youth unemployment 50 to 60% or whatever, just not wonderful conditions. The outcome, I don't want to speculate, and I'll go back, I don't want to speculate on what is going to happen over the weekend or whatever. I could guess. What I think should happen is Greece should exit. I totally agree with everyone else that's said that can happen in an orderly way. To me, though, the bigger question, the banks have positioned themselves, everyone should have positioned themselves for a Greek exit. And everyone ought to have positioned themselves a bit of contagion or whatever in markets in Portugal or whatever. They should be positioned for that. Hopefully, though, people in the Commission or hopefully in the ECB or whatever are doing a little bit more than that and actually trying to work out, can we work out what the rules could be for a future exit? Let's not go through this when Portugal wants to move or adjust, or a Spain or Italy or whatever. Are we going to end up with a sort of an extended period like the end of Bretton Woods or whatever, or can we actually use this as an example as an occasion to write a few rules? So optimistic on Asia and not so optimistic on Europe. Just finally some implications of how I've been thinking about the world. So some of the lessons of what's been going on. First of all, the lessons from the GFC were, don't forget Keynes, discretionary fiscal policy has a rule. The lessons today, flexibility with sound institutions is key. That's essentially why Australia's ridden through the Asian financial crisis or the tech bubble or the GFC or whatever. But at the same time, don't assume that there'll be never any problems. Watch for bubble, watch for imbalances or whatever. One thing I haven't talked about is we have got income distributions issues and equity issues, both on an individual basis and across communities or whatever. There are tensions there, and economics does have social implications and can have substantial feedback loops if we're not careful, and so don't forget those. But the final punchline is I just am really very positive about how digital can and is starting to transform the Australian economy. So, thank you.
So I now ask our speakers to come up and form a panel. Rick Symes, the great professional, finished in 17 minutes. Now, because we actually started this segment late, because we started late to give the room a little bit of time to fill, we've only got exactly 10 minutes left of panel time. And I know Stephen has to hit it to the airport pretty much after 4:30. So I'd just like to open it, rather than me opening it up with the questions, which I can do, I'd like to go directly to questions from the floor. So are there any questions in the room? At the back row.
I've got a question for Andrew. So you did this ranking of... you did the ranking of economies at market exchange rates. For welfare and things like that, it's actually PPP that's more important, I would have thought. So why is it so important to look at the ranking as far as market exchange rates go?
The reason why we looked at market exchange rates were twofold. The first was to capture that argument that I don't think was made enough when the commodities boom was in full swing and the Australian dollar was very high, that actually the global purchasing power of Australians was incredibly strong, and Australians buying stuff off the net at prices you couldn't get domestically or going to Hawaii on a half-price holiday were actually ways all Australians benefited from the boom, and I didn't feel that that had been communicated well enough by policymakers at the time. The other reason why we calculated that ranking was to highlight really, taking that as your starting point, what a policy regime that requires all of the adjustment from mining to non-mining activity be borne by monetary policy and the exchange rate does versus an adjustment that might be more focused on productivity. Now, if you want to look at living standards within countries or compare the living standard of one country to another, sure, you do a PPP type basis, but doing it on a PPP basis never captures that lift in global purchasing power that we had sort of 4 years ago now when you're at 110.
But purchasing power is determined by the terms of trade. I mean, yeah, the dollar went up and that helped the people buying imports, but it hurt the exporters. And similarly, on the way down, it's helping the exporters right now.
So my response to that, I guess, would be that it hurt the exporters on the way up, but did it hurt them more or less than a non-competitive economy and a lack of productivity growth? And the example that I used was the car manufacturers. The currency's back at, what, 75 cents. The average since the float's probably 70. You're within a fat thumb of the average of the float, since the float, yet not one car manufacturer is ever coming back. So, you know, often in these things, it's also about thinking of how do you communicate what it is you're trying to communicate. And the important thing about saying you're going from 5 to 17 wasn't the numbers, in my view. The journalists like that bit. The important thing about communicating that and getting that out there is actually to say, hold on, this productivity stuff matters, and here's a way to communicate it in a way that you can actually also get it in the daily telly. It's a political economy.
Yes, Steve Austin.
Stephen, I want to mention or get you to
You've got a mic there, Steve.
Very much. John Fraser's comments about productivity, you reiterated his thoughts. It seems to me the problem for him and for you is getting the policymakers to address this. And I've heard that speech before in different forms, the constant concern about productivity, but no one seems to be getting through to either side in Canberra. And I asked John, is he educating them? Who's educating them? And my question is to you, is there someone that they're listening to actually get this message across? Because I've heard repeatedly this message, but it's not coming out of the people that matter, and that's Tony Abbott and Bill Shorten. Bill Shorten doesn't want to do productivity because his workers see that as meaning you want me to work harder, and Tony Abbott says I don't want to raise the work choices vampire from the grave again.
The answer to your question of who they're listening to is their political advisors, and the problem with the productivity story is productivity is hard. Productivity gains normally accrue over the very long term, and in the very near term you make enemies because you destroy jobs, you impact people negatively in the near term, and the payoffs come well down the track. And what the politicians are very fearful of is that they'll create enemies in the near term by doing the productivity that's tough, and their opponents, who probably are in government down the track, will get the benefits. And I think that's one problem. The other is the very short-term nature of the political cycle. We've seen one-term governments in Queensland, we've seen a one-term government in Victoria, we've had perilously close to one-term governments federally in the last 10 years. And the incentive is just not there to do the hard stuff. And I was, as I said, in Treasury during the good old days of the Hawke-Keating days when we were doing the tough stuff like tariff reform and enterprise bargaining was introduced and floating the currency and deregulation. That was really hard. But remember, Hawke was in power for a long time, followed by Keating, and then we had Howard Costello was in power for a very long time. So I think it's the combination of the lack of political will, but also they're doing exactly what their political advisors are telling them, which is not make any enemies. It's distressing.
Michael, can I have a go at this too? Productivity is a funny beast. Competition or incentives or whatever, the heart of the macroeconomic reforms was, could we get a bit more competition into the system? Could we expose people at the edge, leading edge, to better incentives and the like? So that was tariffs, that was foreign banks in, that was quite a few of the reforms. In addition, could we get a fair bit more flexibility into the market? And so that was labour market reforms, that was how we changed the financial system and the like as a country. Today, if I'm looking forward and trying to work out where are the big gains likely to come from, I first of all note that some of the big sectors clearly are services, and some of the ones that are hardest to make progress on are education, health and whatever. And how am I going to get reforms there? Well, I can get reforms in those sectors through COAG agendas and all the rest of it. And the demise of the COAG Reform Council and all the rest of it, I think, is a sad thing because it was moving in that right direction. But put that to one side, there's still a lot of potential to get quite substantial changes in health and education, just to keep those two, through things like digital. Indeed, what's going with digital and retail is all about an empowered consumer. If we had empowered patients, empowered students and whatever, and forced change there, that can be a bit of a driver. We're getting fantastic examples of changes at the edge in digital things in both those sectors, but it's only at the margin. We need to have it across the board. The next comment I want to make is that a lot of what the changes going on at the moment are being driven by consumers, improving consumer welfare and the like, but won't be being picked up in productivity. And the classic is what happens if digital lowers barriers and you get more choice, and you can have a whole wide variety of choice of products, but at a similar price. Just one example, if you look at, there's a study that looked at Amazon as a bookseller, and Amazon does two things. One, it reduces costs along the supply chain, and so prices go down. The other one, it provides more variety. The study estimated the economic welfare improvements because of that, and the variety one was about 8 times as large as coming from taking costs out of the supply chain. Taking costs out of the supply chains will be reflected in productivity. The variety one won't. And that sort of thing, if I look at infrastructure, a lot of the reasons why we're trying to do things in infrastructure is to reduce congestion. Won't be in GDP or productivity as measured. And so this is sort of an appeal to the people in the room who want some academic projects to do. If we can work out how choice, how congestion and all the relationship in this modern world between consumer welfare and productivity, that would be a fantastic thing to get a better handle on that.
And that exactly exhausts all the time for this session. We've had a presentation this afternoon from three absolutely excellent business economists, in Stephen Walters, Adam Boyton and Rick Symes, and I think we should show them how grateful we are for their presentation. Thank you very much. No. Three. Okay.
Okay. Alrighty, it's Friday afternoon and everyone needs to go home, especially those who have travelled a long way to get here, so I won't hold you up, but just to formally close the session and the conference as well for this particular stream, if you just indulge me for 2 minutes. So thank you for all our panellists here today for coming for the Business Symposium sponsored by QIC and Suncorp. That was extremely illuminating presentations focusing both on the short, medium and long-term perspectives for the global and domestic economies. So we thank you for your insights. I'm the Treasurer of the Queensland branch of the Economics Society and it's my pleasure to close the conference here. I hope you found it a successful and interesting and stimulating conference. We've had, as you can see on the screen, more than 150 papers presented. We've had 52 invited speakers and panellists talking across 6 keynote presentations, 3 professional development seminars, 8 policy panels, a business symposium day and a PhD colloquium. So we've been quite ambitious, I think, in what we've tried to put on for our attendees, and I hope you found it interesting and useful. There's a lot of people to thank and a lot of people who have put much work in to the conference. The steering and logistics committee members are up on the screen. A few I'd like to point out individually. Timothy Wanhoff, who's the president of the Economic Society of Australia, Queensland. He's been working tirelessly, absolutely non-stop. I get emails from him literally around the clock. And I think his commitment to excellence has been reflected in the conference outcome that we've got, and I hope that you've enjoyed it, because certainly he worked very hard to put it on. Julian Pearce, Vice President here in Queensland as well, has done the same. Unfortunately, he's ill and is not able to be with us, but certainly I think his fingerprints are all over the conference. As are the Angela, Lauren and Claire from QT Events who've put on the conference. Normally QT Events, I understand, put on conferences for roughly 100 to 200 people. We had over 500 people at this conference, and I think everything ran particularly smoothly. So I think they did a fantastic job. We also had the program committee who sifted through all the papers that were submitted, expertly led by Uwe Dulick here at QUT. They did a lot of work and I think contributed to the success of the conference also. And I hope you all enjoyed yourselves. Thank you very much for attending, for giving up your time, for being away from family, for those who have travelled. I hope you got a lot out of it. Papers are available on the website, so please do check those. Photos and videos are also available. Patrick Hamilton did a fantastic job. You would have seen him floating around the place, taking photos. He did a wonderful job, and you can see more photos and videos available on the sites listed there as well. And the final group to thank for the conference are the sponsors. Our diamond sponsors Deloitte Access Economics and QUT, platinum sponsors UQ, AGL, QIC, Suncorp, the RBA, Treasury and Griffith, Gold sponsors the Productivity Commission, University of New South Wales, Queensland Treasury and Queensland Treasury Corporation. Silver sponsors the ABS, Department of Industry and Science. And the supporters of our conference, the ANU, the ABE, Adept Economics, NCER, the University of Melbourne and Elsevier. I think you'll agree our sponsors are a bit of a who's who in terms of economic policy, government and private sector institutions. So we're very grateful to have them on board. And as Treasurer, knowing that we had their financial support helped me sleep a little bit easier at night as well. And just to wrap up then, thank you for your attendance at this conference. The conference we have next year, the Economics Society is putting on, hosted by the South Australian branch, is in Adelaide. It's the 45th edition of the conference. Mark Henley spoke very engagingly last night on some of the topics that might be discussed. So it promises to be very good. And we hope, I think he very humorously talked about, Adelaide being on the doorstep of the McLaren Vale. He talked about the economics of the grape. He talked about 25 years since Paul Keating's comment in regards to the Banana Republic, so he talked about the economics of bananas. He promises a conference about the economics of fruit, and he promised that it would be a peach of a conference. I think we need fruit to nourish ourselves. We need economic debate, dialogue and discussion to nourish our intellect and intellectual curiosity. So I encourage you to attend, and we'll see you in 2016. Thank you and have a safe trip home.